Pacioli, way back in 1494, wrote the first book on how to succeed in business, and I've called it the Pacioli way. He didn't tell merchants then how to buy or sell or trade, but he did see them failing, and he saw them failing because they were not keeping their accounts properly and not doing business plans. So we're going to have a look at what he advised and how it works. Pacioli said, you must regard your business as if it was a person, separate from yourself, and you should keep its records from its point of view. Here we have the owner standing next to her business and probably identifying with it too. But she shouldn't. So let's separate them. There you are. The owner invests some cash in Robbie so that it can begin to trade. Robbie doesn't own the cash. He owes it back to the owner. It's her capital. And Pacioli was a mathematician, and he said, this is a little equation. Assets equals liabilities. Cash equals capital. I can build a worksheet that'll help us plan and keep our records that way. So let's have a look at it. This is the way that we're going to use Pacioli's worksheet, keeping to the simple equation assets equals liabilities. There's not a debit or a credit in sight, of course. Now, Pacioli went on to develop debits and credits, and if you want to see those, please watch my YouTube, Paci for the Web. And that's followed by Pacioli and the Merchant of Venice. You can see those two videos on YouTube. Just put in the names. They'll tell you all about Pacioli and how he developed himself and double entry. However, let's get back to this one. As you can see, I've entered 100 for cash that was put in by the owner, and so it's her capital, her claim on the business, also 100. Every line has to balance. Cash is a sterile thing, isn't it? Won't earn anything, put it under the mattress, won't grow. So let's buy some inventory, or rather let Robbie buy some inventory. We'll need another column for that. We never get stuck in accounting. If you can't see where to put something, just open another column. There, now we have a column for inventory, and I've put 60 into it. But Robbie didn't pay for it. He bought it on credit. So we need an accounts payable column too. There it is, with 60 in it. Now we can begin to trade. We can start to sell, or rather, as I always say, Robbie can start to sell. Let's have a look at that. Robbie sells some goods, but again, he doesn't get immediate cash for them. He sells them on credit, so we need an accounts receivable column. And of course, when you sell something, you create revenue, so we need a revenue column. There they are. But now that he's sold some, he's no longer got 60 in inventory. So we have to have a cost of goods sold figure and take some out of inventory and put it into expenses. Now that's interesting, isn't it? An asset has become an expense. As they're used up, they become expenses. Robbie pays some wages in cash. The accounts receivable people pay some of what they owe, but not all of it. And we pay all of what we owe to the accounts payable people. Now let's see whether we've made a profit. So we open another column, profit and loss, and we transfer into it the revenue first, and then the expenses. Now let's total everything up. This will be our closing balance sheet, and we can see if we've made a profit. We have. Now let's see what this would look like as published accounts. As you can see, the three main documents are all here. The profit and loss account, outlined in black, the cash column, outlined in red, and the closing balance sheet, outlined in blue. We can rewrite those now into a more traditional form. Let's look at the profit and loss account first. Robbie seems to be doing quite well. Sales are 80, cost of goods sold only 20, a gross profit of 60. Wages, minus 15, net profit 45. Pretty good. Now this is a story. It's telling us how we got from one year to the other. But there is another storybook, the cash flow statement, which tells a story but from a different angle. Let's have a look at it. The owner invested 100. In trading, wages were paid of 15, suppliers were paid 60, but the customers only paid in 30. So overall, we used up money in trading of 45. So when you compare the profit, which was also 45 by coincidence, with the amount used up of 45 in cash, you can see that there is a potential problem. It is profitable, but it is using up cash. Robbie, better be careful. You can be profitable and still lose your business if you don't get the money in. But this is, of course, a forecast. So let's have a look at the next year and see what Robbie is forecasting for that year. Then we can compare the two and see what we think of it. Now we have an opening balance sheet. That is the closing balance sheet of the previous year. That's how you link them together. And we can see how he's doing. He's bought 120. On credit again. He sold only 50. The cost of goods sold of those 50 was just 15. He paid 15 in wages again. The accounts receivable paid up 60. The accounts payable, as us, or rather Robbie, paid 80. And now we can see whether we made a profit or not. So we transfer the revenue, 50. We transfer the expenses, 30. We add it up and yes, we've made a profit of 20. And there's our closing balance sheet. Now let's see what they look like when they're compared together. Let's look at the profit and loss account first. Well, sales have gone down. Cost of goods sold has gone down, but not as much. The gross profit's lower. Wages the same. And net profit has dropped. I say has all the time. I mean will have if he carries through this forecast. Now let's look at the cash flow. He started the first year with 100. In the second year, that's gone down to 55. He paid wages. He paid suppliers. Customers paid him. Not much. So again, he's used up money. This doesn't look too good, does it? I think Robbie's going to have to think about revising what he should do. What else can we get out of it, I wonder? Well, the balance sheet tells a story, doesn't it? Inventory has gone up from 40 to 145. Accounts receivable has gone down. Cash has gone down. And he now has some accounts payable. So although he has total assets which have gone up a bit to 165, it doesn't look too good to me. And I, if I was examining this company, would now want to work out some ratios. I would be looking at sales growth, the profit margin, how many days of inventory he had, how long were accounts receivable taking to pay him, how quickly was he paying the accounts payable, and so on and so on. There are many more, but I shall do another video explaining them in more detail later. But of course, this is a forecast. And so far, as you've seen, I've been putting numbers into those worksheets. Well, I wouldn't. What I would do is to put references so that in a different place I could change the amounts. And then, because all these worksheets are linked together with the closing balance sheet becoming the opening balance sheet of the next year, I could see the results of changing my estimates, until I felt happy with the results I was seeing and that I could achieve them. That's what being in control of your business and succeeding is all about. You notice too that the sales in year 1 of X is a combination of products, price, and sales volumes. You can break every one of these cells down into more detail behind it. It's very powerful. I mentioned earlier that you could look at Patchy for the web to see how all of this developed. Well, I've just put on the next slide a quick summary of what you would find when you go to that particular video. This is a taste of what is in my first video, the very first one I ever did. And it tells you about how Pacioli developed the accounting system, or rather how he investigated the one that was existing in Venice in the 15th century. And, as I've already told you, he was a mathematician, so he thought in mathematical terms, and identified the equation assets equals liabilities. Then he said, well, to stay in business, you better make a profit. So now we have assets equals liabilities plus profit, which also belongs to the owner, of course, or is owed to the owner. Then he said, well, profit is revenue minus expenses, so let me put that in. Assets equals liabilities plus revenues minus expenses. Oh dear, a minus sign, and the clerks can't handle those. I know. I'll add expenses to both sides. That'll get rid of that one. And now we've got assets plus expenses equals liabilities plus revenues. Assets and expenses on the same side? Well, yes, assets are a store of unused expenses. As they get used up, they become expenses. Now we've got an equal sign there still. Can't have an accounting system with an equal sign. Let's subtract liabilities and revenues from both sides. The ones on the right will disappear. Now we've got assets plus expenses minus liabilities minus revenues is a self-balancing situation. Every row will equal 0. Then he thought, I don't need to put signs on the names if I put signs on the numbers. And there we see assets, expenses, liabilities, revenues, plus X, minus Y, plus Y, each row balancing to 0. He saw a problem with that too, because you would be mixing up plus and minus items under the same heading, particularly in cash, which would be dangerous. So the Venetian method separated them out. A column for plus and a column for minus under each heading. And then, of course, you couldn't really have the minus signs showing like that, and so they used the words debere and credere to disguise them. Debere meaning to owe. Anything the business holds, it owes to the people that supplied it. And credere meant to trust. The people that supplied these things were trusting the business to pay them one day. So debit and credit, DRCR, replaced plus and minus, as you can see. However, I'll tell you more about them, as I said in the first video, patchy for the web. Now let's summarize what we've done on this video. We've seen how we can build up a series of years, 1 to 5 in my case, all linked together by the closing balance sheet of one becoming the opening balance sheet of the other. And out of those we can get profit and loss accounts, cash flows and balance sheets for all of the years. And out of those we can get ratios. We can change the numbers. Everything changes once you make one change, and you can see the results and see whether or not you can achieve them. That's how it all fits together. And it's all in my book. Understand Accounting. I wrote it about Andrew, who's setting up a new business as a taxi driver. And it's all there. And you might like to visit my website with case studies and other information too. understandaccounting.com. See you at my next video.